Good morning, everyone. I'm Phil White. I'm Chair of Mobico. Welcome to our audited results presentation for the 15 months ended 31st of March 26. Joining me today are Brian Egan, our CFO, and Paco Iglesias, who was promoted to Group CEO last April. You've met the three of us a few times before, so you've got to know us a bit more over the last year. I think we warned you last time that our reporting period in 2026 would be a bit complicated, so many apologies for that. And today's presentation is a bit later than we planned, but as you know, it's been a World Cup year, so we've been in extra time, and we've been in extra time. We've had a few VAR reviews, but very pleasing to say, no yellow cards, a clean set of accounts. So we delivered good results in 2025, and we've made a strong start to 2026. This start has enabled us to build up a stable platform to de-risk legacy issues and take the business forward. Over the last year or so, our focus has been still on simplifying and restructuring the group to make it stronger. We've had a lot of legacy liabilities to manage, but we've made a lot of progress. We're now on track to deliver the 75 million cost savings we promised for 2026. This is equivalent to 100 million in a full year. We've also dialed back our CapEx to a more disciplined 120 million per year, starting from 2027, and we're also looking at more ways to significantly reduce our costs even further. In Germany, we did what was absolutely necessary to de-risk our rail contracts. In the RME contract, we improved profitability and removed revenue risk by entirely shifting it from a net to a gross contract. RRX is still loss-making, but we've successfully reduced its lifespan by 3 years. On a combined basis, these changes mean that our rail ops will now be at least cash neutral over their remaining contract lives. This brings more certainty to the group and frees up more management time to focus on the future rather than the past. It's important to note here that we still have some payment advances we are discussing with the German PTAs. This is one of the legacy liabilities that Brian will explain in more detail later. German rail is not the only area of our focus, as we've been rationalising other parts of our business. During the period, we exited 2 loss-making subsidiaries in UK Coach, and we've addressed 2 significant loss-making contracts in the States in WeDriveU. As always, the jewel in our crown, ALSA, delivered another set of record figures. This was driven by continued strong performance in Spain and also growth in our international and our diversified businesses. It's no surprise that ALSA is increasingly playing a more important role across the group. So based on the strong start to 2026, we've raised our operating profit guidance for the year to 215 to 230 million. Looking ahead, our priorities are plain and simple. We're continuing to stabilise and de-risk the group. We're maintaining the strong trading performance of ALSA by continuing to invest in the business. We're completing the monetisation and de-risking of the UK bus business. We're also continuing to streamline our central framework by removing the corporate glue that holds us back. We're focusing on cash generation to help us de-risk and de-leverage. And finally, we're looking at all options to manage our balance sheet better, as the current level of debt is too high for the size of the group. I think this is important. However, let me now hand over to Brian, who will take you through the numbers in some detail.
Okay, thank you very much, Phil, and good morning, everybody. Today we're reporting on an extended 15-month period ending the 31st of March 26. Since we previously discussed our 12-month results, the focus today is our trading progress in Q1 and other key areas of focus. When measured against the previous 15-month period, Revenue increased by 6% to £3.4 billion, driven largely by ALSA's stronger growth momentum. Group adjusted operating profit grew 18% to £231 million. Statutory operating profit was lower at £12 million. This gap between adjusted and statutory operating profit continues to reflect a number of significant adjusting items. We discussed these in detail at the 12-month results, and an updated breakdown is included in the appendix to the presentation. Free cash flow of £132 million came in lower than 12 months 24, largely due to the cash outflow related to school bus business prior to its sale back in July 25. And very importantly, covenant gearing remains well within the tolerance at 2.9. Turning to the first quarter of 26, we saw continued operational momentum with group revenue increasing by 28 million or 9%, with group adjusted operating profit nearly doubling from the equivalent period a year ago. ALSA's revenue improved by 29 million and adjusted operating profit by £6 million. It's important to highlight that ALSA's strong performance is well balanced across the business. Long haul continues to grow and is boosted by the government's single ticket initiative. Regional and urban are both growing strongly. Health, transport and other diversified activities are seeing particularly strong momentum. And very importantly, we also recognised our first technical service fee from Qiddiya contract in Saudi Arabia. Finally, in Morocco, operations have stabilised after December changes, and we remain profitable in Morocco. WeDriveU shows a £4 million improvement in operating profit. However, this is mainly due to losses in WMATA during quarter 1 of 25, which were not covered by the onerous contract provision. UK Coach has had a difficult quarter of trading, with levels of competition remaining high. Adjusted operating profit is down by £4 million versus the previous year. This mainly reflects a provision taken in March related to a legal claim made by a supplier. However, we are confident of a positive outcome which will be reflected in the next reporting period. Our UK bus business continues to be affected by lower passenger volumes and higher costs. This, along with changes to the treatment of supplier rebates, resulted in quarter-on operating profit worsening by £4 million. This was supported by a subsidy from Transport for West Midlands of £18 million. So it's a very important point. We're supported by a subsidy from Transport for West Midlands. German Rail recorded a £12 million improvement in operating profit, reflecting the financial benefits of stabilised operations which commenced in quarter 4 of last year. This also includes a £6 million benefit related to the ORX 1 emergency award contract, which was operated between 22 and 23. Central function costs have almost halved to 2.9 million, showing the right sizing where central functions is progressing well. On the back of good quarter 1 results and revised contracts in Germany, as Phil mentioned already, our adjusted operating profit guidance is being adjusted from up to 205 to 230 million. That's from 195 to 210. In ALSA, the Young Summer Initiative in Spain restarted last month, and we are already seeing volumes above last year's. Taken together, the remaining divisions are broadly expected to offset central costs, and we continue to focus on reducing costs and are implementing a number of initiatives to improve performance. Adjusted operating profit for WeDriveU is expected to be broadly in line with 25 as focus returns to core operations and streamlining the business, and a transformation is well underway. In UK Coach, the focus remains on improving the competitiveness, and we expect the benefits of integration in ALSA and significant cost reduction to make an impact in the second half. UK Bus is expected to be broadly break-even, with local authority support offsetting the decrease in patronage that the bus industry has seen nationwide. Central costs have reduced significantly. However, increased audit costs have offset most of the savings. We expect the audit fee to normalise once we return to our usual reporting cycle. Underpinning our increased guidance is our strong cost visibility, noting we are 100% hedged on fuel for the full year 26 and nearly fully hedged for 27. I want to spend time talking about our legacy liabilities and the impact these are having on our balance sheet. The core business is generating strong cash flow, which is enabling us to reduce these legacy liabilities. However, these liabilities are impacting on our ability to reduce debt. For the retained school bus claims, we have a provision of £62.5 million to cover expected settlements. The cash outflow will occur as the claims are settled over the next 5 years. The school bus purchase dispute is also capped at £35 million. However, we've made an appropriate provision and we expect the outcome to be substantially below that. Again, we'd expect this cash outflow to take place in 26. We also have German PTA advances of circa 130 million. These consist of historic penalties and overpayment subsidies. We are in discussions with PTAs in regard to the value and timing of these repayments. We currently expect these will be repayable over the lifetime of each contract. Finally, we have a pension deficit in the UK of £53 million. Here we have a 3-year funding arrangement to see annual cash outflows of just under £20 million. Now moving on to cash flow. We have excluded the negative contribution of a school bus to show a clear picture of our cash flow. Focusing on the first quarter of the year, we spent £32 million on maintenance capex and net working capital inflow of £22 million. We made a £4 million in pension deficit contributions and paid £14 million in interest. Overall, free cash flow was £55 million, and free cash flow after growth was £50 million growth capex. The improvement reflects our much more disciplined approach to capex and working capital, which Phil has mentioned earlier in his presentation. Looking forward, we expect capex this year to be at 135 million, that's in the calendar year, due to prior vehicle orders. But we remain fully committed to our disciplined target of 120 million per annum from 27 onwards. Despite the disciplined capex target, we are still able to pursue new growth opportunities throughout by focusing on capex-like contracts. For example, the joint venture contracts in the Middle East and elsewhere in ALSA, as well as asset-light opportunities in the US. Now moving back to the 15-month figures. We delivered free cash flow after growth in M&A of £40 million. We received £286 million from the disposal of the school bus business and had £158 million of cash outflows relating to adjusting items. Again, a fuller breakdown of adjusting items is included in the appendix. We spent £43 million on the hybrid coupon payments, noting that this reflects we had 2 coupon payments in the period. Other movements saw a £10 million outflow, leaving the group with net funds inflow of £115 million for the 15 months. Adjusted net debt at March 26 was at £1.1 billion, down from an opening balance of £1.25 billion at the 31st of December 24. Covenant gearing of 2.9 is a 0.2 times increase from the 12-month unaudited results at the end of 20 and a 0.1 from the end of 24. We expect net funds inflow of £50 million before legacy liabilities over the remainder of the year. As a result, we expect our overall cash outflow as the business de-risk legacy liabilities. However, we do expect a small reduction in covenant at December 26, so we expect the covenant ratio to come down at the end of the year. Finally, our liquidity position remains robust, with a 0.8 billion in total liquidity, including 240 million in cash. We have more than sufficient runway to manage our private placement maturities in mid-27. 86% of our group debt is maintained at fixed rate, and the weighted average rate is at 3.5%. For the hybrid, the coupon rate reset at 8.1% last February, and the first payment at this higher rate is scheduled for February 2027, and we'll decide on that payment closer to the time. So to sum up, debt reduction remains the board's absolute priority. To achieve this, we are driving operational excellence to generate strong and predictable cash flow and de-risking our UK bus operational assets ahead of the recent transition to franchising. Turning to deleveraging, the board and management are working closely with our advisors to evaluate all of our strategic and financial options to deleverage, and we will be providing an update later in the year. Now, please can I hand over to Paco.
Thank you, Brian. Thank you, Phil. Good morning, everyone. I'm Paco Iglesias, and as you know, I've been appointed CEO in April, so that means that I have spent already 100 days, the first 100 days, actually 120. And what I think that you expect from me is to have a vision of where we are, and I'll try to do from the operational side. I think my main goal for today is that you understand the position where we are, that is completely different where we were 6 months ago, and to keep being transparent with you. I think the same that all the numbers that have been shown by Brian, I'll try to do the same through facts over narrative. I think I'm an engineer and I like numbers, I like real facts. So first to say is we are in a completely new company. I think it would be easier for me to explain what have been running in the same way that we were 6 months ago. But and I think thanks to the leadership of Phil that has given us all the confidence to make all the changes, and I think all the team I have, and I want to thank especially people who are here, James, Helge, Marcos, Patty, of course, all of you, because you have made a great effort in these days. So I have good and bad news as everyone. Bad news is we inherited a company in a very, very difficult position. I think you have seen from Brian, and but the good news is we have a very solid plan, that not a solid plan for the future, a solid plan that has been implemented in the last months, and that is giving us some outcome, some positive outcome on that. And don't expect from me to give you a new strategic plan with new consultancy firms, or all the work has been done by these guys and the rest of the team that are working. We started from the top to down with the main ideas, what are the things that we have to do, and after that, bottom up, we designed all the initiatives that I'll try to sum up in a while. Very simple things in order to recover your trust on the company. Just first, and I think it's in this specific order. First, establishing operations. You know that we have some operations that we are not working well, performing well. So this has been my main priority. I will go through every single division right now with some facts, but this is the first. And if you ask me, I would say that we are more than 50% done in terms of the change on operation. Second point is the risking contracts. You know that we have a good pipeline of businesses, but we had several issues in the company, as Brian and Phil mentioned, that fortunately, I would say 80% of them, we have now avoided of them in several ways. So I think the two main points are quite ahead of where we are. Third point is, I think when you reach a position like me, first thing that you want is what's my goal? To generate cash, and how to get that more revenues or less cost. So we have designed internally a very solid plan in terms of savings and reduction on capex that I will show you right now. And finally, we cannot live for the future only with savings. We need to keep the illusion, the happiness of the people, because when we are able to grow and to have new contracts, and as you have explained, and I go later, we have had some success on growing in the last months. This is very simple. This is the plan that we have, and with figures, facts. You can ask me how. First point, and capex. to get a reduction. You know that we come from more than 150 million CapEx in a year, and the commitment is a real fact that for this year we will have a reduction in CapEx of more than 30 million. This is a number. It's not an opinion. It's not something we need to achieve. This is something that we have got from that. Or the savings. We have more than 100 initiatives that are going to give us in a run rate 100 million of cash. For example, in terms of overheads, in terms of central expenses, we have achieved so far more than 25 million reduction on savings. This is the second point is everything related with the loss-making contract. You know what is happening with Mata in the States, what has happened, the problem in Germany, some other points where we have been working. And finally, we are still growing. We have launched a new huge contract in Spain, in Ibiza, and also in Qiddiya in Saudi Arabia. And right a couple of weeks ago, we were awarded as preferred bidder of Medina. Medina is a huge contract in Saudi with more than 220 buses, and we will run operation with a local partner as well. So everything is with the same goal: to generate cash, to improve position, and to keep performing better. Let's go division by division. I'll try not to be so long. ALSA, you know that I know ALSA very well, but one of the questions that I remember from last presentation was, would be ALSA able to keep growing, to maintain the margins, and to be on that position? Well, this is numbers. This is revenue. We have been able to grow the revenue by more than 10% with all the things that and I think I can move here. Long haul, that is, I will go to long haul later, but long haul, the growth in long haul is not the most important part of the company in this period. We have been able to grow, but the main part where we have grown a lot is this international and other businesses and diversification. This is the key of the contract that we have had. And as you know, Morocco, we had a problem at the end of last year, and we have lost revenues. But fortunately, now we are still the leader in the urban transport in Morocco, with 4 cities, the number 1 and number 2, Casablanca and Rabat, and we are making profits in Morocco as well, not at the level we had in the past, but we are still having. And of course, we are taking advantage of the policy of the government in order to support public transport. That I will go later with UK because I see some similarities with the UK. But this is the main messages I would like to show you. And it's important, number of passengers is almost 10% because I will go later with that. This is another key question from especially I remember Gerald 10 years ago when the franchises the franchise system in Spain. Well, just maybe we haven't been able to explain better how the system works in Spain. We run about 200 contracts for long distance, from regional, for urban transport, some other kind of contract, with more than 50 PTAs between Spain, Morocco, the areas where ALSA run. We have under a tendering process between 5-10% every single year for the last years. So it's not a question that the franchising system is stopped. What we have had is in long haul a delay on the process, but in the last year we have also gone for bidding. So this is important message. We have roughly 20 contracts every year that we have to renew. And what's our success on them? The ratio when we are the incumbent is 95%. If you ask me last year, 25 is 100%. But well, sometimes we lose some contract. And when we are not incumbent, the ratio could be 20-25%. So this means that we are still in a process that we are in a good position. What about margins? What happened after a tendering process? Of course, you have to reduce fare, and we have to, our margins usually, it's a range, it's a lot of contracts, different contracts, could drop 3-4%, it depends. But as I showed you earlier, number of passengers last year 8.8%. What it happens after the tendering process, we usually keep growing number of passengers. So the historic, the background we have in the tendering process is after 2-3 years, we're in the same margin that we had in the past. And sorry, I say that the margin that we have kept in the last year is even higher than what we have. We have been in ALSA margins between 12 and 14 in the last, well, from COVID. So in the last 5-6 years, we have not made significant change on that. Let's go to the States. If you remember the key messages I said from the operational side, CapEx, savings, loss-making contract, and growth. Let us start. In terms of CapEx, we are going for pushing opportunities in the state for asset light. So we don't want to keep spending money on CapEx, even we have some good opportunities, but it's not the right time to do that, so we're not doing that. On the savings, we have changed completely the company in the States. Now we work in the States more similar on what we do in ALSA, for example, with regional areas, 5 regional areas alongside the country, and a very tough central department headquarters who takes control of finance, legal, procurement, safety, everything where we can get significant savings. So all these people that were working in the past in the regional areas, now we have been able to reduce. So significant savings on that. Loss-making contracts. We avoid the 2 significant loss-making contracts that we had in the past right now. So I think it's another of the main goal we have. And growth. We have a pipeline of, I think it's written right now, of more than 600 million in terms of, we have a very little market share in the States, less than 10%. So the capability that we have for growth is too high. We will be very disciplined, very selective with the process where we want to go. UK coach. I have to acknowledge that this is something that I'm not happy with in the operational side, but I'm optimistic. What has happened? Probably we have a significant delay in the integration of UK coach of ALSA. Maybe I misunderstood all the difficulties that we have on there. But let me give you some facts. Our main competitors there have grown in number of flights, number of mileage, up to 70% in the last year. We have lost less than 5% of passengers. But we have also need to reduce our average ticket by another 2-3 points. So this is part of that. But if you go to the strategy that I pointed out first, CapEx. We are now in a process that we are going to make new agreement with third parties, and we are going to transfer part of the fleet. Here with me is Rafael, the Managing Director of UK, that if you ask later, he can answer. It's a joke because he told me earlier, please don't ask me any question. No, but he's in a process. We are going to reduce our own fleet by half. So this is an important savings. We got on the overheads in UK and general expenses, as I said, more than 25 million. loss-making contract. We have avoided the non-core businesses that we were running in the past. But not only that, we are in an operational plan that we are avoiding the routes with less profitability. So we are going to reduce our network significantly, keeping the most profitable routes. So this is another. And growth. For example, we have introduced the revenue management tool coming from ALSA, and let me not give you many details because of the competition, but we are growing significantly passengers in some areas of UK where we have already introduced this tool. I think, like I said, I'm not happy, but I have a very positive vision that we will be in break-even at the end of this year or next year at all. UK bus is a different strategy. You probably have read in the last days that the new Prime Minister has said that he wants to support public transport. He wants to change the rules from the age of Margaret Thatcher, and now he wants to have a local control with control of the asset in the local areas. What has happened in UK in the last years? London has grown passengers a lot, but the rest of the area has been dropping number of passengers. It's not a question of, it's not only West Midlands what we run, the rest of the cities, Manchester, Liverpool, and the rest. So what's our strategy here to de-risk this business? So what we are doing, we have in the process of monetization of the asset and making savings, because even with the patronage that, as I said, is coming down, we are still in a quite flat as we were 1 year ago. That I think is not that easy to achieve. And for growth, we have prepared a new bidding team in order to fight for the franchises, not only West Midlands, but the rest of the opportunities with positive margin. We are not going to go for only for size, only for being award. It's just if we are able to make money in our business case. So this is the strategy that we are doing in that. German rate. I'm sorry that I cannot say very much, because we are under an NDA document with the 5 German PTAs, but it's public that we signed a couple of months ago a final agreement with them, and as Brian said, it's going to be. I would be prudent if I say cash neutral from a business that you know that was very negative numbers in the past. But it's not only because of the agreement. For example, in the operational side, when I'm more comfortable, we got a significant improvement. For example, for the first time, we have 100% of the drivers that we need for running the company. Even more, we are hiring part of our drivers who comes from our training center to third companies, and we are getting money, of course, of that. We are in the moment of when we have less penalties for the company in the story of the company. Another fact: we have the best safety ratio in the industry in Germany in the area. These are facts, public facts. And finally, we are working in terms of growth strategy, and as I said, growth. We are now working to create a platform there, because you know that we are the largest private company in the area where we run trains, that is Westphalia. And now there is a public tender where we have been pre-qualified, and the idea is trying to increase our business there and to create a platform that could add a lot of value in the company, because it's very difficult to enter a market. It's very difficult to enter a new market, especially in rail, and we are there, and we are now in a very stabilized business. I think this is the last one. Just a summary of where we are. very focused on cash generation. I think I have given you examples of every single business that are real initiatives. Of course, I said that we have changed completely the company, and it's not a surprise that we are working in a model more similar on how we work in ALSA, for centralized with very tough control of the procedures and so on. And finally, well, for example, in the organizational side, we have also our new COO, Rafael Sterling, who joined the company in the last days, and he will be he's in charge of procurement, safety, maintenance, everything, but not for ALSA, for the whole company. It's the first time that we have a single role for the whole company with the same procedures, with the same goals for all the countries. And finally, as I said, cash generation. I've never failed in a budget. I can do, of course, in the future. But I think another fact that's clear, Brian has said, we have given a new guidance for this year with an increase of by 10%. And I can assure you that if we have said that, we will hit the numbers. I'm not able to accept that we are not going to fulfill with the numbers and to put excuses. I can assure you that if we say this is the number, this will be the number. So very difficult times, thanks to all the team, but we are on track of getting the things fixed. And the thing I have nothing else. Please feel if you don't mind to close.
I'll close up. Thank you. Thank you, Paco. I'll get your name right this time. I often do that, you know. I think people call it a senior moment, which often applies to me, but sorry, Paco. Look, I'll change the opening of the script. Again, it's been tough. I can't tell you how tough it's been. There's been a lot of issues and a lot of surprises, and some of the surprises have been pretty unpleasant. But we're tackling them, we're dealing with them, and we're getting there. But dealing with stuff like this when you're a contract business, it takes a lot of hard work, a lot of time, and a lot of cost. It really does. It costs us cash, as Brian showed you. But it's better getting it done, better getting everything clean, and having some nice businesses rather than businesses that hemorrhage cash. So I want to reiterate and start by saying, look, we've made a great start to 2026, and we hope it continues. ALSA continues to outperform. ALSA is absolutely key to the group. We continue to invest in it so it can achieve its growth potential. The stabilisation of our German rail contracts, which looked impossible, but we managed to get it. It ensures our services have a future, and we can continue to operate a quality service. Which, as Paco's already mentioned, we are hitting 100% service levels now. In the UK, we are progressing the monetisation of our UK bus assets in the West Midlands to de-risk the business well ahead of the move to the re-regulation of bus services and the introduction of bus franchising. Every move we make now is focused on driving cash generation and managing these key issues we inherited. This includes driving further cost savings over and above those we announced in the 2025 12-month results. There's more to come. And repeat it, I think, for the fourth time today, we've upped our guidance for 2026 to between 215 and 230 operating profit. Our priority, which is a huge one, is leverage reduction. We are working closely with all our advisors to look at every option that's available to us so we can deleverage the business and get the balance sheet in a much better state. That's the real job this year. So we'll give you an update on all this in the second half of the year. But as usual, many thanks to all our people, whether they're driving buses or trying to close accounts. Everybody who works tremendously hard for us. thanks to our shareholders and our stakeholders and our advisors who sometimes get very tired of this, so we appreciate that. So we thank everybody for their patience and understanding. And to return to my World Cup theme this year, we're all out tonight for a hydration break. I really appreciate what Peter have introduced, so we can do this. So over to you guys now. Any questions you want to ask us? Thank you very much. Gerald, are you first in again?
Thanks. Gerald Koo from Panmure Liberum. Three, if I can. Starting on the deleveraging point, you talked about evaluating options. Is there anything that you would rule out at this stage, in particular equity issuance? What's your stance on that? Secondly, on the UK bus pension deficit, firstly, if you could just clarify whether the 53 million is sort of IFRS or is it the actuarial deficit? And why has it increased so much? And given the fact we're now in a, shall we say, a normal interest rate environment, would that not imply that certainly the deficit should be shrinking rather than growing? And then finally, on CapEx, you talked about the sort of lower annual target from 2027 onwards. How sustainable is that? Is that buying fewer vehicles? Is that a lower CapEx bill as a result of financing structure? If it's buying fewer vehicles, what does that mean for the average age of the fleet?
Okay. I'll split that between the three of us, Gerald. On the first question, the balance sheet review and looking at our debt levels, we're in the position at the moment, we're not ruling anything out at all at this stage. Brian, on pensions?
On pensions, it's an actuarial funding deficit, so we've got a defined benefit scheme in the UK. It's an actuarial deficit of 53, which actually also is reflected in the accounts, and we've evaluation every 3 years. But one of the points of that is it does relate to UK bus, and we are looking to monetize that asset, and that would be rolled into that particular transaction.
Yes, on CapEx, there is not a single reason behind this. I can give you some examples. For example, first is that we're going to buy less vehicles because we have avoided some loss-making contract, and we are also in negotiation process with PTA to extend the age of the fleet. This is one point. Second point, we are buying more affordable vehicles. For example, we have introduced Chinese vehicle in some of our operation that makes us to make significant savings. And third, we are now in a process of operational scheduling fleet that in the process of cascading to be able to be more efficient in taking advantage of the fleet from the first hand to the second hand.
Jack.
Jack Cummings at Berenberg. Three questions, please. First one, if I could just ask on the guidance. I think what you said is kind of ALSA seems to be performing a bit better, Coach a little bit worse, and obviously you signed the German agreements. Could you help us kind of bridge from the previous guidance to the new guidance? Second question on We Drive You. Obviously exited WMATA and the CART contracts. Guidance is for profit to be flat year on year. How should we think about kind of the growth profile of that business, both in terms of revenue and margin? And then finally, just going back to kind of the UK bus point, if you are able to monetize those assets in the short term, would we anticipate that any transaction would be covenant neutral, or could this actually help in the deleveraging? Thank you.
Thanks, Jack. Brian.
Let me just take a couple of those. First of all, with guidance. So the guidance has been improved, or has been increased because of a number of factors which you've actually mentioned. I mean, we're going to see the benefit of Germany coming through. We're seeing the benefit of stronger ALSA performance, and which Paco spent quite a bit of time of managing the downside on trading for Coach. So it really is a combination of all of those, and then we will update again when we do our September results.
Can I add, if I have to say very simple, I would say the improvement in guidance comes. ALSA and Germany are going to perform better. I don't expect significant variation in UK bus, UK coach, and with review. And we will have also material savings from the central functions. So if you add all these things, I think it's not difficult, is not the right word, but it's achievable at all to look at that.
Could you just say a little bit more on the opportunities in the States?
Well, in the States, as I said, we are focused mainly the asset light. So we are not now looking for opportunities in shuttle because it's more heavy capex. But we are entering in a new segment that is universities, and with some of them, and also in the community, some community services there. But as I said, for the next 12 months, I was reviewing the other day, there are more than 30 opportunities. So we are going to be very selective because we are not capable to go to all of them. But it's mainly university, asset light, and in the geographic areas where we are, as I explained, we have 5 different regions, so we are not trying to enter a new region where we don't have presence, where we have to start from scratch. So very sensitive, sensible, sorry.
The final one is UK bus, and it's quite an important one to understand. Really, offloading that is about de-risking the business. So in terms of the covenant, it's really going to have very little impact on the covenant. But what it does is we have assets, and we focus on getting full value for our assets. But on the other side, we have quite substantial liabilities which carry risk. So one of them is the pension, which you mentioned earlier on, Jared, which now has a 53 million deficit. Defined pension scheme carries risk all the time. We have a risk constantly because we have to get funding from the local authority. So it is actually a loss-making business, but getting funding all the time. That requires lengthy negotiations every year. And the third issue is we have very substantial leases associated with the business, over 300 million pounds worth of leases, and there's quite a detailed description of those in the accounts this year. So what we will do by offloading this business is we de-risk it by offloading leases, offloading pensions, offloading the funding risk that we have every single year, and for that we are taking off our assets. But in terms of covenant, it really has very little impact.
Good morning. It's Rory Cullinane from RBC. A couple of questions, please. Firstly, on covenant leverage, encouraging you expect that to tick down by year end. Should we expect that to continue into full year 27 for any, excluding any potential disposals or anything like that? And then secondly, German rail interested, your interest in potential new contracts there. What would you like to see in terms of contract terms or risk reward to bid for further business in German rail? Thank you.
Brian.
On the covenant, we are expecting it to improve by the year end. I think we're not really going to go out further than that because there's so many things hurdles we've got to leap over the next while in terms of the balance sheet. So I think at the end of the year we certainly expect it to be better than it is at present.
The German contract, well, it has been launched right now, so we are still in the process of analyzing the ITT, and but we are working in the financial model, in the negotiation with the provider, because for that, and the negotiation also with the PTA. And we are working in a different way that we had in the past. We are working with 2 different teams, like a Chinese wall, in order to keep clear that we don't make mistakes. We can make mistakes. Everyone can make mistakes. but it's easier to be more comfortable if we have two outcomes from different groups at the end. And if we see after all the analysis that is not going to be profitable or it's going to take risk, we will not go for it. Completely sure.
Said, these long-term rail contracts are very, very complicated. And if you start with a bad contract, you will never recover from it. And we're not going to get into that position again. So we're spending a lot of time on due diligence and what the contracts actually mean when you're operating the business.
Hi, good morning. Jack Rayburn at Bank of America. Two quick questions, if that's okay. Could you give some more detail on the U.K. coach issues? Specifically, do you expect structurally lower pricing in the U.K. going forward, given heightened competition? And how do you see the growth trajectory of that business once you break even, either this year or next? And then on German balances, can you reconcile the 132 million in PTA advances, and you've got 113 million on the German OCP? How much cash is payable in 26, and how should we think about that annually thereafter? And then maybe more generally, how should we think about modeling legacy cash liabilities beyond this year? Thanks.
Yes, thank you. The U.K. coach, as I said, competition is working well, and I think competition is good for us not to be slept. Yes, we are going down our fares because we need to keep some margin, but we are not going to do the same in every single corridor. As I said, there are some corridors where we are even growing average tickets and we are growing passengers. There are some other corridors where we have tough competition and we have to keep competing, and there is some other corridors where we are going to avoid. Yes, as figures, our revenue per mileage, that is a key KPI for efficiency, is we are performing better than our competitor. Our main problem in UK coach is the cost, the base cost. So this is where we are working, and we have done a lot of things, but we have a lot of things still pending to be finalized. So in summary, if we are able to work to run with a base cost simplified from what we have, very good technology in terms of revenue management and a good approach on the corridors, is not difficult to achieve. It takes time, but I'm absolutely optimistic and confident that we will achieve in the next months.
Okay, on German rail, I'm just trying to explain. I was just wondering, would it be possible to put up slide 22 again on the presentation? If I go to slide, do you mind if I just go? So the first thing to say is there are two separate issues. There's the OCP and there's the balance due in advances. So first of all, let me just take the OCP. If you look at, we've got two contracts. We've got the RME and we've got the RRX. So the OCP relates to the RRX contract. So that 130 million, they are the losses we expect to make over the remaining years of the contract, up to 2030. So roughly we're going to be losing about 20 to 25 million a year on the RRX contract. And that loss each year, it goes against the provision. So it doesn't hit our P&L, it goes against the provision. On the RME contract now, that's been extended. So you see this one has been shortened. That's been extended because that's to 2032. And each year we're going to generate cash of roughly the same amount, 20 to 25 million every year. But that could go on beyond the RME. So we should end up generating a little bit more cash. Overall, it shouldn't. We're sort of saying it's cash neutral, but we actually expect to be slightly cash positive in the latter years. So each year, in terms of cash, they're more or less offsetting each other. We're bringing in 20 to 25 from the RME. We're losing 20 to 25 on the RRX. But in terms of our P&L, the loss in the RRX goes against the provision. The profit on the RME will go into our P&L. So we'll get a profit each year. So that will obviously help our covenant, etc. So that's sort of how the contracts work. Separately to that, we have advances from the PTAs, which are sitting on our balance sheet of £130 million. So it's nothing to do with the contracts. That's advances they've been giving us advances each year to run the business. We have to repay that. It also involves penalties. There are two issues. First of all, we have to finalise that number, so it's a provision at the moment. We have discussions with the PTAs to agree on a final number. And the second thing is, in terms of the repayment schedule, we're expecting that to happen over the contract terms. But again, that has to be finalised with the PTAs. I mean, obviously they're pushing to have it happen as quickly as possible, but we want to spread it out as far as we can. I don't know if I've explained that well, have I?
Yeah, so I guess then if we think about like an annual cash drain, you're basically taking out 130 million divided by the number of years left.
Yeah, it mightn't be quite like that because it depends on each contract and when the money came through to us. So when we get advanced, the issue is that there are a number of years behind in their own accounts. So we have to do a reconciliation with their accounts, and then you have a negotiation over the amount that's paid to them. So it's not really equal. It's going to depend on when the advances were paid and were given to us, etc. Apologies.
Could you please split the 132 million between the two contracts?
I'd have to get the details for that. I'm not sure if how much we share on that, because again, it's under discussion. But let me just check to see what we can. I think at the moment I could. In fact, I don't have that information to hand anyway. But it's not only the contracts; it's also each year, because it varies depending on the years when the advances came through to us. But it has nothing to do with the profit or loss in the contracts. It's purely an advance that we have to repay to them. And the other point that's very important to notice now is, that agreement was very important in terms of the saving, because we were looking at, I don't know if we've ever disclosed the amount that we were going to lose, but it was very, very substantial. It's a very, very big number, running into hundreds of millions, which now isn't going to happen. And the second issue is we now have a business which actually has a value. So before we had a business which had zero value. So while we've got an amount that's due of the 130 million, we also have a business now that has some value. So I don't know whether I've explained that. I was trying to work out in my head how I would do it. But okay.
Any more questions, guys? Are we done? One more. Gerald again. Come in again.
I think it will have to be the last one, unfortunately.
Yeah, Gerald from Panmure Liberum again. Just one. On the bus availability contracts, you talked about trying to exit those on a commercial basis. If you went all the way through to franchising, I can understand who would you sort of transfer those to. It's whoever runs whoever wins the business. That might be yourselves, might be someone else. If you're looking to exit them early, who do you transfer them to other than Transport for West Midlands?
Difficult to answer that one at the moment, Gerald. We're in really detailed discussions on this one, and we've got to be very careful what we say, because we're not there yet. So please forgive me for not answering it.
Just be, you need the buses still to run the service.
Absolutely.
Right.
Yeah. Or else we've got no business. But we're in negotiation about the assets and all the liabilities we've got, which Brian's mentioned. Okay, guys. Thank you very much. Thanks to everybody who's joined us in the room today, and thank everybody who's joined us on the webcast. And hopefully we'll see you soon. Thank you very much.